China's silver squeeze, why Shanghai's record lows threaten the global market. Welcome to today's analysis, where we look beyond the immediate noise of the equity markets to the bedrock of the global economy, physical commodities. Today, we are dissecting a seismic shift in the silver market, a development far more critical than the retail-driven squeezes that periodically capture headlines. The epicenter of silver's structural instability has migrated decisively from the west to the east. This is not merely a financial story. It is an industrial and geopolitical event unfolding in the vaults of Shanghai, where physical inventories have collapsed to levels that threaten the very functioning of the global supply chain. The physical reality is screaming distress, even if the paper markets remain complacent. To appreciate the gravity of this situation, one must understand the structural dichotomy of the precious metals markets. We operate in a bifurcated system where the price is largely determined by the trading of derivatives on exchanges like COMEX in New York and the LBMA in London. This system allows for immense leverage, meaning the volume of silver traded on paper vastly exceeds the actual physical metal available for delivery. This financialized structure works until industrial demand aggressively outstrips immediate supply, forcing participants to demand physical delivery rather than rolling contracts forward. The previous crisis point focused on the London Bullion Market Association, LBMA vaults. Inventories dropped to dangerously low levels, threatening the integrity of the Western financial infrastructure. However, the LBMA system managed to recalibrate. Through opaque swaps, aggressive importation, and the calming of retail fervor, Western vaults achieved a fragile equilibrium. This stabilization lulled many investors into a false sense of security, believing the supply crisis had passed. But the pressure hasn't dissipated. It has been transferred across continents, evolving into a far more potent threat. The new epicenter of distress is the Shanghai Gold Exchange (SHFE) and the Shanghai Futures Exchange (SHFE). Unlike their Western counterparts, these are fundamentally physical delivery markets, reflecting the immediate supply and demand dynamics of the world's largest commodity consumer. The latest data from Shanghai is alarming. Inventories are registering record lows. The continuous drawdown of physical metal indicates that demand is rapidly consuming every available kilogram, suggesting a market operating on the brink of severe tightness. This migration from a financial center, London, to an industrial hub, Shanghai, signifies a transition from a crisis of confidence in paper markets to a crisis of physical availability. The catalyst for this drawdown is multifaceted. For months, a persistent arbitrage opportunity has existed between Western markets and Shanghai. Silver prices in China have consistently commanded a premium over London and New York. This differential naturally incentivizes the flow of metal from west to east. However, the sustained premium indicates that the flow of metal has been insufficient to close the gap, signaling persistent, unmet demand within China. This arbitrage acts as a pressure relief valve for the West, but dramatically tightens the Eastern market. Furthermore, we must analyze the internal dynamics of Chinese production. Recent analysis highlights a critical downturn in domestic silver output. China experienced a notable month-on-month decline, attributed to several localized issues. Maintenance shutdowns at major copper smelters, which produce silver as a significant byproduct, have constrained supply. It is crucial to understand that the majority of silver supply is derived as a byproduct of base metal mining, making its supply relatively inelastic to the price of silver itself. If copper operations are disrupted, silver supply suffers regardless of the demand. Compounding these production issues are reports of declining raw material grades at lead zinc operations in key Chinese provinces. This is a critical, often overlooked point. Ore quality is declining globally. Mines are exhausting high-grade deposits, requiring the processing of more rock to yield the same amount of metal. This increases production costs and limits the ability of miners to rapidly scale up output in response to price signals. The supply constraints are therefore not merely temporary logistical hiccups. They are rooted in the geological realities of an extractive industry facing increasing demand. A critical acceleration in the Shanghai squeeze occurred recently when export windows became favorable. Chinese smelters, recognizing lucrative opportunities abroad, diverted a significant share of their production to international markets. This action drastically cut domestic allocations, reducing them to the bare minimums required by long-term contracts. While this boosted export revenues for the smelters, it hollowed out the domestic physical inventory. The consequence was predictable yet severe. A domestic short squeeze materialized almost instantly. The impact on the ground in China has been profound. Smelter inventories reportedly plunged by approximately 50% month-on-month by the end of October, an astonishing rate of depletion for a major industrial commodity. The scarcity is further evidenced by the sharp rise in spot premiums for silver ingots. When the physical market is tight, buyers must pay significantly above the benchmark price to secure immediate delivery. Rising premiums in Shanghai are a direct barometer of market stress, reflecting intense competition for limited supply. This situation highlights the inherent fragility of the global supply chain. We are witnessing extraordinary measures being taken to move physical metal across continents. Reports indicate traders are booking transcontinental air freight to move bulky silver bars globally to satisfy immediate demand hotspots. Air freighting silver is extraordinarily expensive due to its bulk and density. These costs are typically reserved for high-value commodities like gold. When market participants pay these exorbitant rates to move silver, it is a clear indication of desperation, underscoring that the market is operating with minimal buffer stocks. The near-term outlook remains one of extreme tightness. Market sources suggest that some Chinese producers are still withholding spot sales, anticipating higher prices or perhaps prioritizing strategic reserves. The prevailing picture is one of tightening supply and thin inventories across the entirety of China's silver sector. This brings us to the crucial role of silver in the modern economy, which is fundamentally different from that of gold. Silver is a hybrid asset, a monetary metal, but more importantly, an indispensable industrial commodity. The aggressive global push toward decarbonization is inherently silver-intensive. Photovoltaic cells, the core component of solar panels, require significant amounts of silver paste. The growth in solar energy capacity worldwide is exponential, and this demand is inelastic. Manufacturers cannot simply substitute silver without sacrificing efficiency. Similarly, the electrification of the automotive sector relies heavily on silver, as electric vehicles use significantly more silver per vehicle than internal combustion engines. This rising industrial demand profile is colliding head-on with the constrained supply situation. The result of this collision is a persistent structural deficit. For the past 5 years, the world has consumed more silver than it has produced. This deficit is not a cyclical anomaly. It is a structural feature projected to continue well into the latter half of the decade. These sustained deficits have been quietly eroding the global above-ground stockpiles, held in exchanges like the LBMA and the SHFE. The record lows in Shanghai are the visible manifestation of this long-term erosion of buffer stocks. We are now approaching a critical tipping point. The depletion of Shanghai inventories means the market's shock absorbers are gone. In a tightly supplied market, even small disruptions can have disproportionately large impacts on price. The tipping point will be the moment when the physical tightness in Shanghai begins to dictate global pricing, effectively decoupling the Eastern physical market from the Western derivatives market. If Shanghai inventories continue to deplete, international suppliers will be increasingly incentivized to direct metal towards China, draining liquidity from London and New York. This drainage could lead to a situation where the available physical supply in Western markets is insufficient to back the volume of paper contracts traded. While bullion banks have historically managed their positions effectively, a genuine physical shortage presents a fundamentally different challenge. If industrial users, fearing disruptions, begin to bypass the derivatives markets and seek direct physical procurement, the pressure on existing stockpiles could intensify rapidly, forcing a convergence between the paper price and the physical reality, leading to a sharp upward revaluation. Now we must address the geopolitical dimension. which introduces significant uncertainty and potential volatility. The current global environment is characterized by increasing fragmentation and strategic competition between great powers. From ongoing conflicts in Eastern Europe and the Middle East to the rising temperatures surrounding Taiwan, the geopolitical landscape is fraught with risk. In times of uncertainty, the demand for hard assets, particularly those with strategic applications, increases significantly. Within this context, we must consider the possibility of strategic stockpiling by sovereign entities, particularly in China. Silver is not only critical for green energy, it is also vital for advanced military applications, including aerospace, missile systems, and sophisticated electronics. Given the rising tensions and the focus on technological supremacy, it is highly plausible that institutions within China, including those associated with the military-industrial complex, are accumulating physical silver bars to secure their supply chains against potential disruptions. While specific details regarding military activities remain opaque and unconfirmed, the strategic imperative for such stockpiling is undeniable. This potential demand from the defense sector introduces a powerful, non-transparent driver into the market. Unlike industrial demand, strategic stockpiling is driven by geopolitical calculations and can occur rapidly and discreetly. If China is indeed accelerating its acquisition of silver for strategic reserves, the existing supply deficits will be exacerbated, placing immense pressure on the already depleted inventories in Shanghai. The implications of this Shanghai-centric squeeze for the global market are profound. While the immediate impact on the Western spot price might be less dramatic than the London squeeze, the sustained pressure in Shanghai will inevitably ripple through the global system. The persistent arbitrage will continue to draw metal eastward, tightening supply in Western markets even if their vault levels currently appear stable. The equilibrium is temporary if the underlying flow of metal remains unidirectional. We anticipate a period of significantly increased volatility in the silver market. The tight physical conditions mean that any sudden surge in demand or disruption in supply can lead to explosive price movements. The market is coiled tightly, and the leverage inherent in the paper trading system can amplify these moves dramatically. We will likely see days of sharp declines, as speculative longs are shaken out, followed by equally dramatic upward surges as industrial buyers scramble to secure physical metal. Furthermore, we may be witnessing a fundamental break in the current market structure. Historically, pricing power has resided in New York and London. However, as the physical market dynamics shift eastward, the premium in Shanghai may become the dominant factor. We could witness a decoupling, where the physical price in the east diverges significantly from the paper price in the west, challenging the dominance of Western financial institutions in the commodities space. The impact on industrial users will be substantial. Manufacturers of solar panels, electric vehicles, and electronics will face rising input costs and potential supply chain disruptions. While some costs can be passed on to consumers, the scarcity of physical metal could become a bottleneck for the deployment of green technologies. This highlights a critical vulnerability in the energy transition: the reliance on critical minerals whose supply chains are concentrated and vulnerable to disruption. The geopolitical competition over silver could intensify, leading to resource nationalism. From a macroeconomic perspective, the tightening silver market contributes to the broader theme of commodity inflation. As the costs of essential industrial materials rise, the inflationary pressures in the global economy are exacerbated. Central banks already grappling with controlling inflation while supporting growth will face further complications. The rising cost of silver, essential for both industrial activity and the energy transition, adds another layer of complexity to the macroeconomic outlook. Looking ahead, the trajectory for silver prices appears constructive, despite the potential for short-term volatility. The combination of constrained supply, rising industrial demand, persistent deficits, and geopolitical uncertainty creates a compelling case for a long-term bull market. The current tightness in Shanghai is likely to act as a floor under the price, preventing significant declines. As the realization of the physical scarcity spreads, we anticipate a significant upward revaluation of silver, potentially surpassing historical highs. The market is currently underpricing the strategic importance of silver in a rapidly changing world. The transition to a greener, more electrified economy, coupled with increasing geopolitical competition, means that silver is becoming one of the most critical commodities of the 21st century. The frantic activity in the physical market, air freighting metal and record low inventories in Shanghai, is a clear signal that the industrial world recognizes this reality, even if the financial markets are lagging. The enduring lesson from this analysis is the critical importance of understanding the physical flows of commodities in a world dominated by financialization. The divergence between the paper price and the physical reality can persist for extended periods, but eventually, the physical fundamentals must assert themselves. The leverage in the financial system can obscure the underlying trends, but it cannot indefinitely defy the reality of supply and demand. We are witnessing a historic migration of metal, and consequently, a migration of pricing power. The shift from west to east is not just a geographical phenomenon, it represents a fundamental transformation in the global economic order. As China and other emerging economies assert greater influence over the commodities markets, the traditional mechanisms of price discovery centered in London and New York will face increasing challenges. The decoupling of the Shanghai price may be the first visible manifestation of this broader trend. The fragility of the global supply chain will remain a key theme. The recent disruptions have highlighted the risks associated with just-in-time inventory management. We may see a trend towards greater vertical integration and strategic stockpiling by major industrial consumers seeking to secure their supply of critical raw materials. This increased competition for physical metal will further tighten the market and support higher prices. In conclusion, the silver squeeze has not ended. It has evolved into a far more significant industrial and geopolitical phenomenon. The record low inventories in Shanghai, driven by production constraints, aggressive exports, and robust demand, signal a market under extreme stress. The structural deficits, fueled by the green energy transition and potential strategic stockpiling, provide a powerful tailwind for silver prices. The revaluation of silver as a critical strategic asset is underway, and the events in Shanghai are the leading edge of this transformation. Investors and policymakers alike must recognize the implications of this shift. For investors, the opportunity lies in recognizing the value of physical silver in a world of increasing scarcity and uncertainty. For policymakers, the challenge is to secure the supply chains essential for the energy transition and national security. The Great Migration of metal is both a symptom and a catalyst of the profound changes shaping the global economic landscape. The illusion of abundance is fading, replaced by the reality of scarcity, and the silver market is the canary in the coal mine for this new era.